Thank you for inviting me to discuss this paper. It's let me just start by saying it's great to be back here. It's been a while. There's a lot of familiar faces. I think this research paper here, I think the capital commitment paper is a great paper, and I think to some extent Mark in his presentation was underselling the importance of this research here. And I think in some sense the question that we are getting at in this research here is one of the most important open research questions in finance. So let me just apologize up front that if I get a bit carried away here, it's because it's great to be here. This is great research, so I'm just having a great time. So let me elaborate on why I think this is a good question to study. So just to set the stage here, as Mark discussed, what we are studying is the asset allocation problem of an institutional investor. So we have a limited partner investing in private equity. Just to set the stage, I think this is a tremendously difficult problem. Let me say there are very few papers out there right now that are trying to solve for the optimal commitment policies for limited partners in private equity. Also, I think this is a tremendously important problem, and I'm only half joking when I'm suggesting that everybody in this room here immediately give up your other research project and start working on this project, this question instead, because it's tremendously important, it's tremendously understudied, and this matters a lot. So let me just back up a bit and explain what I mean. So first, as Mark was explaining, when institutional investors, and we're talking sovereign wealth funds, pension funds here, they allocate capital to private equity, the way that works is that you make a capital commitment today, and then this capital commitment is made to a private equity fund. The fund has about a 10-year life, and this capital is gradually called and invested and distributed, and there is a large component of illiquidity in that process. So that's the first part. The second part is that this is a tremendously difficult problem. So I think it's difficult for two reasons. One is a purely numerical reason. So if you think about this from a dynamic programming problem, what happens when you start looking at limited private equity investments is that every time the limited partner invests in a new fund, it creates at least one new state variable in the limited partner's dynamic programming problem. So you need to keep track of at least how much money is allocated to this fund, and typically you need to keep track of more than that. What that means is that if you invest in 10 funds, well, then you immediately have 10 different state variables, which is intractable. Moreover, the number of state variables change as the number of fund changes as well. So just from a tractability perspective, this is hard. The second reason why I think this is hard is more from an economic perspective. What I mean by that is that once you get into the details of how private equity is organized, there is a lot of different economic effects going on at the same time. And I think it's fair to say that we don't really understand which of those are first order and we should focus on and which ones aren't. Let me also say that when I say there's very few papers that solve for the LP's optimal portfolio problem, what I'm really trying to say here is that I believe there are really only two papers that do this. One is the paper we're discussing here. The other is the one I've written with Nicola Giometti, and I think sort of the reason why the fact that I'm the co-author on the other half of this literature right now is probably why I'm standing up here discussing this paper today. But there are only two papers in this literature here. So let me say, why is this an important problem? Well, I think it's important for two reasons. And I think in some sense, Mark was underselling why this is important. The first, so what we always talk about when we talk about private equity is that the amount of private equity investments in the world are increasing. And that's definitely true. And this increase is dramatic and it's persistent, and that's a fact. I think equally important is that the distribution of private equity investments is puzzling, to put it at least. Let me just give you a few pointers. If you look at the Norwegian oil fund, this is the largest pool of institutional capital in the world. They have looked at private equity and they have decided that their optimal allocation right now is 0. If you look at CalPERS, it's a largest pension fund, as you know. They have around $600 billion. They have looked at private equity and they have decided that their optimal allocation is between 9 to 11%. If you look at Dartmouth College, where I'm currently affiliated, we have about an $8 billion endowment, and the managers of that endowment has decided that the optimal allocation to private equity is 38%. So just as casual evidence, what we're looking at here is institutional investors that allocate to private equity in a range from nothing to 38% of their portfolio. Now, one reaction to that may be that these investors have different preferences and different beliefs, et cetera, and these are optimal. I'm not convinced that that's the answer, for two reasons. One is that the differences, I think, are simply too large to be explained by optimal behavior. The second reason why I think that's not the answer is because this term here, I'm teaching a class in quantitative private equity. And one of the privileges of that is that I've been had an opportunity to call around to, let's call it just sort of advisors and investors in private equity in the world and talk to them about what is the most sophisticated approach they have to managing private equity investments. And if, so let me be careful about how I word this, but let me put it this way to say that if your expectation is that these investors are thinking carefully about the nature of the liabilities and their preferences and modeling the illiquidity and the dynamics of these investments, and if you expect that that is the answer that they give you if you ask them how they do this, then you would be surprised. So let me just leave it at that and dive into what this paper does. So as Mark was describing, we're presenting and solving a numerically, we're solving the portfolio problem of a limited partner. This is an asset allocation problem. This is pretty standard approach. This is a continuous time portfolio problem. It's carry utility. We have the investor here is dynamically reallocating investments in liquid stocks and bonds. This is perfectly standard. We can think of this as the workhorse model in this literature. The LP also commits capital to, in this case, 1 to an infinite number of private equity funds. So how does a private equity fund work in this literature? As Mark was describing, the problem that arises here is that you allocate capital, you commit capital to a fund like this up front. Then a period of time passes. Only then is the capital that you committed called and invested. Then another period of time passes, and then this is distributed back to the LPs. Now, the problem that this creates for the LP is that you may commit $1 of capital to private equity today, but after a time, this time has passed and this capital is called, then you may regret that you only allocated $1, and you may have wished that you had committed $2 if your wealth has increased. Or sort of even worse for the LP, if your wealth has declined and you're in crisis, then this $1 may at that point be too much, and you would regret you had committed that much at that point. So there is this lag in the time from the commitment to the actual investment, and that creates a friction for the limited partner here. Now, what you can see, once you introduce a fund like this into the analysis, you're already creating two new state variables for the investor. One is the amount of capital in this fund, the X in this analysis. The second is we need to keep track of whether the fund is in state C or state D. So that complicates the dynamic programming problem for the LP. So I'm not going to go into the details of all the analysis. There is a lot of stuff here. So let me just in bullet points outline what is going on. We're calibrating the model using various private equity data. I'll get back to that a little bit later. Solve the model for investments in 1 to an infinite number of funds. We introduce a secondary market. You can only sell at a haircut. You cannot buy. So this is reasonable as well. Introduce 2 macro states to adjust for liquidity cycles. I think this is important because there is a notion that investments in illiquid assets are particularly costly when we are in a liquidity crunch. So I think that's important. We extend this to Epstein-Sin preferences. So there's a lot of action going on in this analysis here. The way they then proceed with their main analysis is they're basically comparing 4 different economies. They call this the illiquidity stack. So as Mark was explaining, we start with the baseline scenario where basically this is the most realistic scenario where you're exposed to these different risks and uncertainties that we were describing. And then we're shutting them off one at a time. And then we are comparing what is the welfare increase for the limited partners here when they are no longer exposed to these different risks. So this is a model with incomplete markets. So we are making this comparison, think of this as a certainty equivalent comparison. So we can look at what is the welfare loss for the investor, or sort of the welfare gain, when we are exposing them to fewer and fewer of those risks. So the main findings from Mark here was that, well, if you can invest in more private equity funds and you would like to allocate more capital to private equity, the analysis tops out at around 20% of the institutional investors' capital committed here when they can commit to an infinite number of funds. Mark was describing this as there is a large cost of commitment quantity. This is this effect that you allocate today, but your situation may change. So you may wish you had allocated a different amount. And if you shut that effect down, then that gives a large welfare gain for the investor. There's a surprisingly small cost of the commitment timing risk here, which is this concern about the timing of when the capital call happens. I think that's surprising, and this is certainly an interesting finding as well. So in a nutshell, I would say, I think this is a great paper. I think this is an incredibly important topic. I think this is vastly understudied. Now we have 2 papers in this literature. This is great. I think the paper contains a large number of different economic effects, which I think is good. I think the results about commitment timing risk and the commitment size risk are novel and interesting. I'll definitely cite this in my own work. I think this is great. I think the concerns I have about this analysis may be mostly down to a question of perhaps research taste. I think sort of at the same time, I think this paper does perhaps a little bit too much. And at the same time, this paper does perhaps a little bit too little. So I know I'm hard to satisfy up here, but let me try to explain what I mean by that and sort of give a direction for how I think this analysis could be sharpened even further. So to start with the concerns, the paper may do a bit too much. So as I talked about, this is a difficult numerical problem. Every time you add another private equity fund to this, you add a number of state variables. What that means, and the approach to this is pretty much just they're brute forcing the whole dynamic programming problem here, which means that if you look for the intuition behind the economic effects that are going on, those are in the first order conditions, and the first order conditions look like this. So now I may be a lazy referee, but when I got to this point, I started somewhat skimming the analysis to understand what was going on. And I think that my excuse for that is also that the authors provide no intuition or explanation for what these terms mean or which of these effects are important. So I think when we talk about this as being perhaps a bit too much, I think the analysis here is already so complex that the mechanisms behind what is driving these effects become a little bit of a black box. This is important because the analysis is still stylized, and there are some economic features of this analysis here that are perhaps not entirely realistic. So let me just highlight 2 of them. For example, one thing that's going on here is that part of the analysis, the LP can only invest in a single fund. That means that if you're an LP and you find yourself underexposed to private equity, you need to throw away your current fund before you can invest in a second fund. So that means that activity in the secondary market here may to some extent be driven by the fact that the investors need to get rid of their current fund before they can invest in a new one. So the analogy to public markets was if you could only invest in one stock. So if you want to invest in Apple, you can buy that. If you want to invest in IBM, you have to sell your Apple before you can invest in IBM. Obviously, that's not realistic. And I would like to understand this economic effect better. Is the magnitude large? Is the magnitude small? What is driving this? And the intuition is there. Now, as a second example of this, one of the features of this this optimization problem here is that the LPs can, to some extent, the timing of the investments in private equity is stochastic. But one of the things we don't allow the investors to do here is to wait until they allocate to the next fund. So when you're investing in 2 funds, you have to invest in the next fund every time the previous one distributes its capital. And I suspect that the investors may sometimes benefit from waiting. The reason for that is by waiting, you can get the uncertainty in the other fund resolved, and that will help you better determine the amount you want to allocate to the other fund. So I think there can be a benefit from waiting. Now, they don't allow for that in the analysis, and I'm not convinced that the economic effect of this is large. There's a hint in the discussion that suggests that this could be relevant. And again, it would be great to have a better intuition for this, but again, the intuition for what is going on is in here somewhere. So it would be useful to get a better understanding of the economics that is driving the analysis. Now, the second problem I have, that was the second concern, the second suggestion is that despite doing a lot, the paper may not be doing enough. So what do I mean by that? Well, so the figure I have up here is, this is from a recent draft for, we're preparing a handbook in economics about private equity, and Tim Jenkinson, together with some co-authors, wrote a chapter about private equity, where they are sort of outlining the structure and mechanics of private equity. And that figure 1 is this. This is describing sort of the typical structure of what private equity is and how it's organized. So if you look, I have to stay up here so I can't point, but we have the investors on the right-hand side, investor 1, 2, 3. These are the LPs in the analysis. They're investing in funds. This is the private equity funds in the analysis. It's investment in portfolio companies. This is what it is. Now, but we also have other investors investing in direct investments and co-investments. We have debt providers that are providing capital to the portfolio companies. We have credit lines that can go directly into the fund. We have other funds. So there are other aspects of this problem here that are still not captured in the analysis that we are seeing here. So if I have sort of a laundry list of different economic effects that I think are relevant for understanding private equity, the laundry list would look like something like this. So we have the LP's investment decision, it committed irregular times. We're sort of capturing that here with these croissant arrivals, although we're not giving the LPs perfect choice over that. They can commit to an arbitrary number of funds, well, 1, 2, or infinity. That seems reasonably arbitrary, but perhaps not entirely. Something that's important when you talk to practitioner is this notion of access to funds and selecting funds that they want to invest in. We're not discussing that here at all. I think in some sense that's perfectly understandable because we have no idea how to analyze this, but it still suggests that there are first order effects of this problem here that we just don't have in the analysis and we don't know how to handle. And we can sort of keep going down through the different economic features here, and many of those are captured in this analysis, but some of them are not. Now, I think I want to highlight this because they spent some time on this fact that this is a realistic calibration of the model. And I think this is perhaps the part of this paper that I'm least happy about. So from one perspective, I just think that these models here are not ready to be taken to the data. I think calibrating these models open an entire new can of worms. In some sense, it's a little bit of a distraction from understanding the economic effects going on. So I think this is, we're not really at the point where we can actually take these models to the data and expect to get reasonable estimates out of it. That said, I think there's also, and I don't know how much I should say about it, I think there's also something interesting going on in the way they do the calibration. I don't want to get into details, but I mean, just point out that the PME calibration that Mark was talking about, as I understand it, the way they're approaching this is using a single moment condition to nail down 4 different parameters of this problem. And while this moment condition is nonlinear, I think this is still what could be described as somewhat of a heroic calibration exercise. And I'm a little surprised that you're going down that route because I think there are much more immediate ways of doing that calibration. But again, I think in general, I think that the calibration here is perhaps a little bit of a distraction in general. And my preference would be to focus on the more economic effects. All right, I have just 2 more slides, so let me wrap up here. I think the fact that you're pushing this as a sort of a more of a realistic analysis also puts us in a slightly this spot here where you come up with this recommendation that the maximum investments that LPs can have to private equity is 20%. So that's what's come out of the model. So I don't know what to relate that number to, but I know that Dartmouth have an allocation. So this is from the Dartmouth Investment Office describing the current allocation of the Dartmouth endowment. And just looking down at the rows here, we can see that the allocation to global equity right now has a target of 25%. The allocation to private equity and venture capital is at 38%. So just as a first order check, the numbers here seems to be somewhat out of the range that you suggest. And it's hard for me to reconcile that. Does that mean Dartmouth is off? Does that mean your analysis is missing stuff? So I'm not quite sure these numbers here are ready to be taken to the data. But to end on a positive note, I think that the table here that shows the current allocation for the Dartmouth endowment also underscores the economic importance of this problem. So if you look at the numbers here, what we are allocating to illiquid assets, venture capital and private equity, is 1.5 times as much as we are allocating to global equity. This is a large part of the portfolios. This is dominating the portfolios. And if you look at the right-hand column here, these are 10-year annualized returns. So this is annualized returns. In percentage points, what Dartmouth has earned on its private equity allocation is 23.3%, which is about 10 percentage points more than what they earn on traded equities. So this is 10 percentage points accumulating over a 10-year period. This is a lot. We're not talking basis points here. We're talking orders of magnitude. So this is an important problem to understand. All right, so let me wrap this up. So my conclusion is I think this is a great paper. I think this is an important problem. There can only be, I think we can only have, it would only be good with more research in this area. I think this literature is also at the point where we're still trying to understand what are the relevant first order effects. I think this paper takes a solid stab at the commitment risk and the commitment timing issues. I think this is a great insight, and I certainly learned something from that. If I had a wish here, and this may be more in terms of taste, I would like to see more intuition and a more transparent analysis. I understand these problems become complicated, but it becomes difficult to understand what is going on. If you do want to run with the calibration, I would suggest that you tie that more directly, perhaps, to some of the data. But we can talk about that. But that being said, I'm perhaps less excited about the realistic calibration part of this. I think the literature is just not ready for that yet. Thank you.